So what is the difference between a mortgage broker and a direct lender? Here's you, the borrower, big hopeful eyes. And here is the mortgage broker. Very professional looking. So you come to him and you say you want to get a loan. What he does is looks at your paperwork and connects you with all the different lender connections he has based on the networks he's built up, as well as your specific situation. If you need private money, he'll go to his private money guy. If you need a VA loan, he'll go to the best VA lender that he knows. If you need a FHA or conventional or USDA loan, he'll go to that source. That is very different than, say, if you were to go to a bank. Here is the friendly bank lender, who is a type of direct lender, but what they do is they loan institutional money. So they are more likely to do FHA loans, VA loans, conventional loans, and depending on the area, even USDA loans. So that's what they stick to. Both of these are very different from direct lenders. So let's say what I am is I am a direct lender. And what that means is whenever you go to a broker, the broker comes to someone like me. But we don't lend our own money the same way a bank does. Here is our money. It's got some fat stacks there. But the bank has a lot more fat stacks than us. They've got all the money that their clients deposit into their accounts. And yeah, they can print money out of thin air, but we're not going to get into that. We're just going to think conceptually and abstractly here. So keep it simple. So what we do is actually, whether you come directly to us or a broker comes to us, what we do is we underwrite the deal. So what the broker does is he makes sure you qualify for one of our programs, and when you're paying the loan, it's our name on the final paperwork, not the broker's name. But when you come directly to us on the paperwork of the loan, it's our name because we're the one putting our reputation on the line by backing you. So if you end up being a bad borrower, he does not get hurt. We get hurt. But the way we get our funds is a little bit different. So what we do is we borrow money from a bank at a daily interest rate, a line of credit similar to a credit card, and we're paying daily interest on that. And then we sell it to an investor. So let's see here, what does the investor look like? Maybe they got some cool hair because they're rolling in the money, got the shades, and the sports car. They got the money hubcaps. Cool. Let's move that out there. So that's the investor. We sell that loan to the investor, and they give us that money, and then we go back and use that money to pay off the institutional warehouse lender or the bank. And what he does is that he gets a lot of loans from everybody, all these other direct lenders. He's getting all these loans, he takes them and piles them up in one big ball. That's a pile, that's a scramble of different notes and loans. And what he does, he takes it and sells it to an even bigger bank. Think Goldman Sachs, JP Morgan Chase, not your mom and pop neighborhood bank, but these big institutional investors. Some of them even take something like that and sell them to pension funds as mortgage-backed securities, or CMBS, which is strangely what these guys do as well. So they can sell directly to the pension funds of blue-collar workers and teachers and let's see here, doctors maybe? No, doctors no. Usually public workers, public sector workers. And they do the same thing. These big institutions, they package them up into, well, rather, they take these big old packages, but they're also receiving these same packages from multiple investors. Maybe this guy has a slightly different sports car. Maybe he's balding, but still got the cool guy shades. And so they're each selling it to this institution, which then repackages them into smaller stock market or stocks, and then sells it to them. So these investors can sell directly here to the pension funds, or sell it to the institution, who breaks them down into smaller pieces and sells them back to the pension funds. So this is the basic food chain of lending right here. This is you, this is a mortgage broker, and this is where I come in. I am a direct lender. You can come directly to me, or go through a mortgage broker. And we, the loans we sell that we make, the benefit that you have of going to us or to a mortgage broker instead of directly to a bank is that the bank has very limited and very strict underwriting guidelines. They don't underwrite anything, but they have connections, so they know where to place your loan. And similar to them, we work with multiple investors. This one's got sort of a Lambo. Well, maybe he's got a tank. Yeah, this investor's got a tank. And so we work with multiple investors the same way a broker works with multiple direct lenders. And each of these investors have different underwriting guidelines. So this might have DSCR loans, and DSCR loans. But each of those guidelines for each of the guidelines for each of their DSCR loans are different from each other's. So you may come in and you may have a 1.0 DSCR ratio, and these two lenders don't do that, but this one does. Or if you come in with a 1.15 DSCR ratio, all three of them do it, but his pricing is better. And so then we take your loan to sell to him. We underwrite it according to his guidelines. And what I mean by underwriting it is that we're the one checking your credit and your background and your debts and your income and your finances, rather, not your income, because on a DSCR ratio, the income is based on the building, not your personal income. But we still got to verify that you have the funds for the down payment and reserves to make at least 6 to 12 months worth of payments. And we also check the building. We do the appraisal. We do the appraisal on the building. That's a magnifying glass there. Checking out the building. And we then say, hey, investor, we looked at your guidelines, we checked this out, we did the work, we guarantee that this guy's a good fit for you. Now please buy the loan from us. And they give us preferential pricing because, one, we're taking work off their plate, and two, we're doing our own marketing in order to attract clients like you, and three, the other thing that we are doing is that we're guaranteeing the loan so that we're taking on that risk, because if you stop paying for any reason, he does not take the hit. We do. We actually have to buy that loan back. So that's the difference between a mortgage broker and a direct lender. Because if you stop paying the loan, the mortgage broker doesn't have to do anything. He doesn't lose anything, but we as a direct lender do. So when you come to a direct lender, we're taking on that risk. So you get, and in order to keep you and prevent you from going directly to the investor, we get bulk pricing from the investor, one, so we get lower interest rates, but two, we're also taking on that risk, so the investor is more than happy to give us discount pricing that you cannot get if you go directly to him. It's the difference between, say, buying a chocolate bar from Walmart versus going directly to Hershey's and saying, hey, sell me a chocolate bar. They're not even going to sell to you because you're not meeting their minimum order qualifications, or quantities, rather. If you've ever tried to buy anything from Alibaba, you have experienced this, where they have minimum order quantities. Yeah, you can buy this entire sofa for $1, but you got to buy 1,000 of them. Otherwise, it's going to cost you as much, if not more, than just buying it directly off Amazon or AliExpress. So yeah, that's basically the way the lending ecosystem works. I hope that was educational and that you got something out of it. Thank you.